Welcome to Why Should I Consider Offering a Retirement Plan? Here you will learn how you, your business, and your employees can benefit from a business retirement plan. During today's conversation, we will review what are the benefits of offering a retirement plan, what types of plans are available for your business, how you can boost retirement savings, and how business coaching can support you. Please note that the information that's contained here has been prepared by Civitas Strategies Early Start and is not intended to constitute legal, tax, or financial advice. When dealing with the busy day-to-day operations of your childcare business, the last thing on your mind is likely one of great importance. That's saving for your retirement. While you consider all of your options of choosing and offering employee benefits or paying yourself, if you're a home-based provider, it's important to remember that as a business owner, saving for your own retirement rests solely in your hands. And if you are an employer, you play an important role in helping your employees save for their future. In this conversation, we'll discuss the importance of exploring retirement plan options sooner rather than later, the benefits to both you and your employees, the types of plans available, tips to start or boost your savings, and resources to help you get started. And while today's conversation will be focusing specifically on business retirement plans and will include information for sole owners, it's worth knowing that there are other individual retirement account options available, such as a Roth individual retirement account, also known as an IRA or traditional IRA. And you can learn more about those by visiting irs.gov. It's important to think about saving now. Financial experts estimate that most individuals will need up to 80% of their pre-retirement income to maintain their standard of living once they stop working. That means if you're making $35,000 today, you will need to have $28,000 a year from when you retire onward. However, the average benefit paid by the Social Security Administration is only $14,400 a year, which leaves a large gap for many people to retire comfortably. So how do you get there? Saving in a retirement account now can provide you with the additional income needed to continue doing the things most important to you when the time comes to stop working. So let's take a look at the different types of retirement accounts and the tax advantages of a pre-tax versus post-tax account. When you invest money in a retirement account, you are making a smart financial decision that provides you with tax advantages today and the power of compounding interest throughout your savings journey. These two benefits work together over time in a retirement account to help you grow more savings faster than you can by saving on your own. So there are two types of retirement accounts, pre-tax and post-tax, that each have different tax advantages. A pre-tax retirement account is one where your deposits are not taxed when you make them, but the withdrawals in your retirement are. This means you will not pay taxes on any amount invested into the account, which can help reduce your annual income taxes. When you finally decide to withdraw funds once you stop working, you'll pay taxes on them then. Post-tax retirement account is the opposite. You are taxed on your deposit now, but you're not taxed on the interest you accumulate and the money you withdraw upon retirement is not taxed. For example, let's say you deposited $1,000 in 2022. You would be taxed on it this year, but when you retire, the withdrawal would not be taxable income. For many people, the pre-tax benefit is very appealing since there is an immediate savings when you are still working and your income tends to be higher than in your retirement. However, post-tax retirement accounts can help reduce costs when you are retired and typically have a lower income. So, because of that, most financial planners recommend a bit of both based on your age and retirement goals to balance your costs now and in the future. Another major benefit of retirement accounts is their ability to compound interest, allowing your savings to grow faster over time. In simple terms, compound interest allows you to earn interest on interest, in addition to interest on your contributions. Financial experts agree that compound interest is one of the most useful tools available to help people reach their retirement goals. And here's how compound interest works. Let's go back to that $1,000 that you put into your retirement account in 2022. Let's say it earned 10% interest. In the first year, that's $10. Now, in 2023, you have $1,010. So that's your original $1,000 plus the interest of $10. And your 10% interest gets you $10.10. As you enter 2024, you now have $1,020.10. This continues, and in 20 years, your $1,000 would be worth $7,330 due to the wonders of compound interest. There's both individual retirement accounts that are for you personally, and there's those that are business accounts for your small business. So now we're going to focus on small business retirement plans, which can be one of the best ways to build your retirement savings and that of your employees if you have any. Some of these accounts are made just for sole proprietors. So even if you have no employees, rest assured there is a plan for you. While there are too many financial and other benefits to list here, here's a summary of the key points of benefits to your business and benefits to you and your employees. So the benefits to your business are that the contributions are tax deductible, funds in the account grow tax-free, many flexible plan options exist to best fit your business, tax incentives for starting a plan may be available, and retirement plans can be a great tool to attract and retain valuable employees. The benefits to you and your employees are that the contributions can reduce taxable income. Contributions and earnings are not taxed until they are withdrawn. Payroll deductions can make contributions easy. Interest compounds over time, leading to faster and bigger savings. You and your employees can feel confident and secure knowing you're building a financially sound future. A key benefit of business retirement accounts is the opportunity for company contributions or matches. And we'll talk about this a bit further, but most plans allow or even require companies to provide some contribution to the employee's retirement. These contributions can be a set amount or percent of compensation or be a match, which means that it's tied to the amount the employee puts toward their retirement. Many employers offer to match employee contributions up to a certain percent. For example, an employer may offer to match the money contributed to a retirement account up to 3% of the employee's salary. This could mean that for a person earning $60,000 a year and contributing $1,800 annually, which is 3%, their employer will also contribute or match the $1,800, increasing the total contribution to $3,600 annually. This match is essentially free money for the employee, and taking advantage of it is highly recommended to help accelerate retirement savings. The company contribution or match is an incentive for employee retention since they are getting additional funds. However, the money is oftentimes not available until the employee is vested. Vesting is the time it takes for the company portion of the retirement account to be fully owned by the employee. For example, let's say you make a $600 contribution in 2022, and you have a 3-year vesting schedule. Typically, that would mean if the employee left your business at the end of 2023, they would only have a third, or $200, and the rest would return to the company. If they left at the end of 2024, they'll have 2/3 vested, and it wouldn't be until the end of 2025 that they would have the full $600 if they changed jobs. Choosing the right retirement plan for your business starts with understanding the options and deciding which makes the most sense for you and your employees. There are many types of retirement plans available, each with their own benefits, features, and costs. Most are affordable and accessible to businesses of all sizes, whether you have 1 employee or 100. On this grid here, you will find some of the most popular options, including some of the advantages and disadvantages of each, to help you decide which may be best for you. A simple IRA or simple 401k is just that, a simple way for businesses from 1 person to 100 employees to provide a retirement program. Employees make contributions directly from their payroll and can contribute up to $14,000 in 2022. Employees over 50 can make an additional $3,000 in catch-up contributions. The employee contributions are pre-tax, so they don't pay now, but they will when they withdraw the funds. Employers can match employees' contributions up to 3% of their pay or provide a flat 2% match for all employees. These contributions are deductible for the business. All of the employer contributions are fully vested at the start, so if an employee leaves, they can take the full amount with them. The key difference between the simple IRA and simple 401k is in paperwork and loans. The simple 401k requires an annual filing with the IRS, but can, because of this, allow for loans, which we'll talk about later. A SEP IRA is another easy-to-implement retirement plan specifically for small businesses. The SEP is geared to employer-only contributions that may vary from year to year. That means employees cannot contribute at all. An example is that an employer may choose to do 3% of salary 1 year and 0% the next. The maximum amount allowed for a company contribution is 2% of an employee's salary up to a cap of $61,000. Many sole proprietors like the SEP since it's easy to run. They can make contributions based on their annual earnings, including none at all, and pay for contributions from deductible company funds. Do know that all employee contributions are fully vested from day 1. So if an employee leaves, they can take the full amount with them. An individual or solo 401k is designed for the sole proprietor, meaning you cannot have other employees. The advantage for the business owner is that they can have higher contributions overall, up to $19,500 as an employee and up to 25% of salary as an employer for a total of up to $61,000 tax-free. If you're over 50, there can be an additional $6,500 contributed to catch up for a total of $67,500. Since this is a plan just for the owner, it is entirely vested from the moment funds are contributed. A traditional 401k plan is the business retirement account you tend to hear about the most. A benefit of these plans is greater flexibility in the amounts you can give. For example, most plans allow managers to receive a higher employer match or contribution than employees. They also allow for high levels of contributions, up to $20,500 for employees, with an additional $6,500 in catch-up contributions for those over 50. These are all pre-tax contributions in 2022. Employers can contribute up to $61,000 in 2022. You can also set up vesting schedules to encourage employee retention by transferring ownership of company matches over time. However, they do require more paperwork to set up and maintain, including complex annual tests to ensure that any differences in company matches are not significantly unbalanced. For example, you doing a match of 50% of salary for managers, but only 1% for employees. So let's talk about withdrawing retirement funds. Retirement funds get special treatment for taxes to encourage you to save for the future. It isn't surprising that it's not easy to take your money out ahead of retirement. Generally, if you withdraw before the age of 59 and a half, you will be subject to income tax on the funds and an additional 10% penalty. And for a SEP or simple IRA, this penalty is 25% if the withdrawal is made within the first 2 years of joining the retirement plan. So, let's say if you're in the 22% tax bracket and you took out $1,000, you would have to pay $220 in taxes plus an additional $100 penalty for a total of $320 in fees. That just leaves you with $680 cash in hand. There are hardship allowances for early withdrawal if the account holder dies or for certain health issues, such as unreimbursed medical expenses that exceed 10% of your adjusted gross income, and that's 7.5% if your spouse is age 65 or older. If your costs for medical insurance while employed, so it will cover those. And if you are disabled. You can also have a penalty-free withdrawal of funds for a SEP or simple IRA if you plan to use the funds for college or university or to build or rebuild a first home. If you have a 401k plan, including the simple 401k, you can also loan yourself money against the amount in your retirement. A 401k loan should be considered very carefully since you're literally borrowing against your future. Most financial advisors suggest only using a loan if it is going to be paid back within 1 year and if you are sure you will be able to pay it back. Typically, you can borrow up to 50% or $50,000 of your savings, whichever is less. Though you have to pay interest, this goes into your account, so you're paying yourself. Additionally, the origination fees, which are the ones to get the loan, do tend to be lower than that of many bank loans. Once you've decided on a plan, it's time to start saving. Whether you or your employees you're well on your way to your retirement goals, or if you're just starting out, there are easy ways to boost your savings so that savings can be implemented today. First, you can set up automatic deposits. One of the easiest ways to grow your savings is through automatic recurring deposits. These deposits can often be administered through the employer, so a designated amount of your paycheck is deposited seamlessly into your retirement account on a regular schedule. You can look to increase savings when possible. Financial experts recommend increasing the amount saved into your retirement account each year. There are several ways to do this that will not have a dramatic effect on your day-to-day budget or spending, like increasing automatic contributions by 1 to 2% each year, saving a portion of any raise or bonus received, saving unexpected income like lottery winnings, inheritance, property sale, and others, redirecting any debt payments to the retirement account once you've paid them off. You can also take advantage of catch-up contributions. If you are 50 years old or older and have not been able to save as much as you would have liked, catch-up contributions can help boost your savings as you get closer to retirement. In most plans, these contributions can exceed standard limits and are specifically designed to help older workers set aside more money to meet their retirement goals. Catch-up contributions are a valuable savings tool that should be taken advantage of if possible. So which do you choose? Which option may be best for your childcare business? For family childcare providers, you may want a simple plan. Because of that, the best options are likely simple IRA or 401k, SEP IRA, individual or solo 401k. These plans allow childcare business owners to save money quickly and easily without much paperwork or effort. Some of them, like the simple plans and SEP IRA, also enable you to cover the assistant you might hire without creating a whole new plan. For small to mid-sized centers wanting an easy program, they're probably best with a simple IRA or 401k or a SEP IRA. These options can cover multiple employees while keeping the administrative time and cost to manage them at a bare minimum. While larger centers wanting to offer more complex benefits would look to a simple IRA or 401k, SEP IRA, or a traditional 401k or 403b for nonprofits. Larger centers may want the simplicity of a simple or SEP option. They can be great starting points for adding retirement as a benefit to employees. However, a traditional 401k may also be attractive since you can provide additional contributions and incentives for retention to managers and other higher paid employees. When you offer a retirement plan through your business, you are making a smart financial decision that benefits you, your employees, and your future. You are also making a powerful statement that you care about your employees, their families, and their financial well-being. Offering a retirement plan can be simple, but understanding all the options can be complex. As with all major financial decisions, it is recommended that you consult with your CPA, tax advisor, or financial advisor for advice specific to your business. But as a first step, you can sign up for free one-on-one business coaching with our experts at childcare.texas.gov who can take you through your options and prepare you for your conversation with a retirement plan provider. Thank you.